When a company decides to go public, it is a huge, huge moment. But between making that call and actually ringing the opening bell, well, there's this whole complex, high stakes world. And right in the middle of it all is a figure you've probably heard of, but maybe don't fully get: the securities underwriter. So let's pull back the curtain and really understand their role. Okay, so first things first, we've got to understand the basic challenge here. Every single growing business gets to a point where it needs a serious amount of cash to jump to that next level. And the public market, that's the ultimate source for that kind of capital. Which naturally leads to the big question: how does a private company, full of dreams and ambition, actually get its hands on that massive pool of public money? How do they offer up a piece of themselves to potentially thousands of investors in what we call an initial public offering, or IPO?
Well, it's definitely not as simple as just putting a for sale sign on the front lawn. The capital market is packed with opportunity for sure, but it has its own language, its own rules. For a company that isn't an expert, trying to navigate this world all by themselves is incredibly risky. I mean, one wrong move, one mistake in pricing, and the whole thing could be over before it even starts.
And this is where our key player walks onto the stage. To bridge that massive gap between their private company and the public market, businesses turn to a very specialized kind of expert: the securities underwriter. So what exactly is an underwriter? At their very core, you can think of them as the ultimate financial matchmaker. Their job is to stand in the middle, connecting the company that needs the money with the public investors, the savers really, who are looking for good places to grow their wealth.
A really great way to wrap your head around this is to think about a real estate agent. When you sell your house, you hire an agent, right? Because they get the market, they know how to price it, and they have a whole network of buyers. An underwriter does the exact same thing. But instead of a house, it's for companies' shares in the primary market. They bring that crucial expertise to a super complex, high-value deal.
So how do they actually pull it off? Well, underwriters don't just wing it. They have a specific set of tools and a very clear process they follow to make an IPO successful. Let's take a look at the key steps. First up, they have to figure out the right price for the shares. That's critical. Then, they help the company build its story, crafting these presentations to get investors excited. And here's a big one: they tap into their deep connections with large institutional investors. We're talking about the heavy hitters who can make or break an IPO. Finally, they use all their market smarts to tailor the offering, kind of like a bespoke suit, so it fits exactly what those investors are looking for. But their job goes way beyond just giving advice and making introductions. This next part is where the underwriter really puts their skin in the game. And honestly, it's probably their most important function. It's called the underwriting commitment. And what is that? It's a rock-solid, legally binding promise. The underwriter basically guarantees the company that if the public doesn't buy up all the shares they're offering, the underwriter will step in and buy the rest themselves. And this really drives home just how high the stakes are. It's not just some casual agreement. It's a firm promise to make sure the company gets the cash it needs, no matter what happens in the market. It is the ultimate safety net.
Okay, now take a look at this chart because it really shows you what we're talking about. Let's say a company wants to raise $100 million. That's their goal. But as you can see, what if the public only buys $80 million worth of shares? Well, that $20 million gap doesn't just disappear. The underwriter is legally on the hook to come in and buy those leftover shares to make sure the company hits its target. And here's the kicker: they have to use their own money to do it. This isn't monopoly money. They are putting their firm's capital right there on the line. They're taking a huge, calculated risk that they can sell those shares later on, hopefully for a profit. But there's absolutely no guarantee.
So, when you put it all together, their expertise, their connections, and this massive financial risk they take on, you start to see the underwriter in a completely new light. They're not just a helper, they're a true gatekeeper of the capital market. Now, because they hold such a powerful position, you can bet they're heavily regulated. They have to be registered with the Securities Authority, and they operate under really strict rules to avoid any conflicts of interest. For example, an underwriter can't also be a bank or a portfolio manager. That's to make sure their advice stays impartial and protects both the company and the investors. So let's wrap this all up. What is the underwriter? Well, they're an expert mediator. They're a strategic advisor. They're a massive risk taker. And at the end of the day, they're the market gatekeeper who helps keep things running smoothly for new companies.
They are that essential bridge that lets innovation and growth get funded by all of us.
They mostly operate behind the scenes, right? Their names rarely make the big headlines. But without them, so many of the companies that literally shape our world might never have gotten the chance to go public in the first place. Which kind of leaves you with a question, doesn't it? Is the underwriter the true, unsung hero of the capital market?